Good afternoon, everyone, and good morning to those in Perth. My name's Heather Ruddock. I'm Strategic Engagement Manager at Walters Kluwer. I'd like to welcome you to the CCH Networks Forum on the R&D tax incentives and the changes that are being foreshadowed in the budget of this year. It's my pleasure to welcome especially our esteemed panel. In the chair, we have Mark McNamara, who's the Vice President of the Group of 100 CFOs, and he will be facilitating the conversation today. We're also delighted to have an expert panel from each of the Big Four accounting firms. And I'd like, in the order of presentation, to welcome Kristina Kipper from KPMG, Sandra Boswell from PwC, Laurence Osen from Ernst & Young, and Todd from Deloitte. Without further ado, I'm going to hand this over to Mark, who will step you through how the format is going to flow today. For those in the room, though, may I just ask you to check your mobiles, please, to ensure that they're on silent or turned off. Thank you, Mark.
Thanks, Heather. Just in terms of format and flow of today, we've obviously got a few in the room here. We have something like 280 people dialing in via webcast, podcast. So we've got to do a couple of things to facilitate that. But before I go into that, I just thought I'd say Mark McNamara is my name. I'm Vice President of Group of 100. For those of you who don't know the Group of 100, it's largely the group CFOs of the largest organisations in Australia, predominantly the ASX 100, with a few other by invitation members. Just in terms of, I guess, an overall perspective from that group on R&D tax incentives, I just offer a minute or so of input and comment on that. I think generally speaking, CFOs lead or right in the middle of investment decisions in their organisations, and I think we would say R&D is an investment decision just like many other decisions. It shouldn't be driven just by or around tax. Certainly tax can make an investment more or less attractive, but it should be treated, decisions around that should be treated like any other investment. I think in this day and age, with globally mobile capital, obviously big and small organisations are making decisions about where they invest. Particularly, our members are pretty much largely global footprints, so they have the capacity to move investment globally, and obviously they can choose to do that into more or less attractive tax incentive jurisdictions. So it is important to get this right. I think it's as important for existing mature large businesses as it is for small businesses, because those largely our members are mature large businesses, and they do have, as I said, global footprints, and they can move investment around as they so choose. Smaller organisations obviously also substantially drive the economy, so I think it's important to understand that. I'd just like to also say that the Group of 100 is actively at the table with both the federal government and federal opposition. We have a lot of meetings. We prepare a lot of papers. We have a lot of meetings with federal ministers and federal department heads. Just by way of example, we were down in Canberra for a meeting about 3 weeks ago. The whole board of the G100, we met with the whole opposition front bench for finance and a number of the other significant ministries, and we raised a number of issues. So the point of stating that is that we do have an ongoing capacity to be bringing issues up, particularly from our member organisations, and putting those forward and advocating for those. Just in terms of the format for today, we've obviously just started at 12:30. We've got a hard close at 2 o'clock. We've got a number of facilitated discussions / presentations. I'd encourage everybody to ask questions as we go. For those on the webcast, I would encourage you to, if you wish to ask a question, look at the bottom right-hand corner of your screen, click on it and you can ask a question directly. I've got a iPad here. I'd encourage you to do that promptly because very important, I guess, is that we ask the questions in that context. I think for the podcast folk, there's probably no other comments that I need to make. Once again, just encouraging everybody to for it to be an interactive session and for everybody to feel free to ask questions as we go. Heather's asked everyone to turn off their mobiles. I'll try and keep track of time to make sure we do have a hard close at 2 o'clock. I think that's all I've got in terms of administrative stuff. So let's kick off. Thank you. Okay, so I think in order, Kristina, you've got a bit of overview stuff. Heather, do you want to just scroll over? I'll hand over to Kristina Kipper from KPMG, and you can lead off. Thank you.
Thank you very much, Mark. So we just thought it would be useful to give you a bit of history of the R&D tax incentive, just to put into perspective these proposed changes and where they sit and what we've seen over the last more than 30 years. So the incentive in its various forms has actually been around for more than 30 years, so close to 35 actually next year. And it was introduced as the R&D tax concession in 1985. At that point, the rate was very generous, was a 150% deduction. My colleagues here, some of them probably remember the book with the green book, with a big 150 on it. And that equated essentially to a 15 cents and $1 additional tax saving. When it was first introduced, there was no requirement to register within 10 months of the year end. And so over the coming years, people could actually go back and register multiple years. So there was no stopping the retrospectivity. However, that was then shut down in '96, which was a major milestone in the history of the R&D tax concession then. So two things happened, or a number of things happened. One was the rate got halved, so it's not dissimilar to what we're looking potentially at now. So it went to 125, which is 7.5 cents and $1 benefit. The definition got tweaked, so the words high levels of technical risk were inserted, so the high levels was new. And then there were also, as I said, from then on, you couldn't go back indefinitely. It was only for the current income year that you could register. And the syndications were also shut down. In 2001, we saw some other new measures. The positive side was that for the first time, there was a refundability added to the tax incentive. And that was for anyone with a turnover of less than $5 million, but there was a cap to it. So you could only go, initially it was 1 million, then it moved to 2 million. So again, we're kind of seeing a little bit of that sneaking back potentially. And also what happened, there was a change to how you could treat plant that was brought in line with Division 40 depreciation rules. Because prior to that, you could actually just write it off really quickly. It was quite generous. And that's how we saw a lot of big claims. And the other reason I saw a lot of very large claims in certain industries was the feedstock provisions weren't in place yet. So it didn't really matter whether you sold anything, whether there was any useful output. As long as you used it in R&D, you could claim it. Yep, so it was extremely generous. So, and then there was also a premium concession at that time, the 175. So that was actually 22.5 cents on the dollar, which looked at the previous 3 years, and to the extent that you actually increased your spend, you could access that. It was in 2011 that there was a major rewrite, and that's when the tax concession became the R&D tax incentive. So for the first time, we saw a tiered structure in the sense that we actually had one rate apply for companies with a turnover of more than 20 million and another rate for those with a turnover of less than 20 million. So they were at the time 40% tax offset and a 45% tax offset. So what we actually saw there, the rate went up. Yeah, so it went from 7.5 cents on the dollar to 10 cents on the dollar. So, just to give you a bit of an idea that this has been going on for a long time, up, down, but it's survived in some sort of way. We saw a complete change in the definition. So it was rewritten. However, I think most of us at the time thought it doesn't have a major impact really on what qualifies. Yeah? So yes, there was a rewrite, but so much more focus on experimentation, on new knowledge, rather than technical risk and innovation. There was a change to how software rules applied, and this is actually quite significant because under the old scheme, there was a multiple sale rule, but under the rewrite, there was a new test and include and exclusion that is about internal business administration. And my view is that at the time, that was one of the measures where I think the government expected a major reduction in claims from financial institutions, around software. But that didn't actually really eventuate. To the extent that they were hoping. The other big savings measure was the introduction of the dominant purpose. So when R&D is done in a production setting, just to keep it simple, you had to all of a sudden demonstrate that it was done for the dominant purpose of R&D, but it only applies to supporting activities. So again, didn't quite see the reduction in the claims. So what we saw then, a few years later, is the cap being introduced to really actually make it, put a legislative limit on the number of claims and the that we saw. And then only 2 years ago, the rate was reduced by 1.5% for both tiers. That was at the time explained as being in anticipation of a income tax rate reduction, corporate tax rate reduction, which hasn't happened yet. So we have been living with a slightly lower rate for the last couple of years. So look, just to set the scene a little bit, and now we are seeing new changes being proposed. And really, I would probably like to say to everyone in the room and on the line, there hasn't really been a year where the R&D tax incentive hasn't been under sort of some pressure, some suggestions of a change, some scrutiny, and we'll get to obviously the regulator activity in a minute. But so I'll leave it at that, but hopefully gives you a bit of a background where we've been in the past.
Thanks, Kristina. So that's just contextual setting. Does anybody have any questions of Kristina before we move on? Yeah? No, if you just, I'll repeat it if everyone can't hear.
That's great context, but is Australia at a disadvantage compared to other countries who have set their R&D policies and stuck with them? So the businesses have set it. You've got any comparisons with other countries which have done much better than we have at R&D because they've been consistent in their policy setting?
Okay, sorry, just slight mic adjustment. Yeah, look, we are, and that has been the subject of many submissions that I've seen and that we've made, and also to Mark's point, it is something that businesses factor into business decisions, and these are investment decisions that look forward by 2, 3, sometimes 5 years, and so it is this lack of certainty has really hurt Australia, and we have not seen that kind of ping pong going on in other jurisdictions. And we might comment a little bit later on some other jurisdictions in more detail. So very good point. Thanks, Mike.
Okay, thanks, Kristina. We might move on then to Sandy, who is going to overview for us some of the detail of the proposals in the most recent federal budget for companies over $20 million turnover.
Thanks, Mark. Thanks for coming along to the session today, and I think Kristina just gave us some great context. So just leading on from that, what we then saw as in the past sort of 24 months has been a lot of review activity. So there's been some comprehensive reviews done of the program and a lot of submissions done by probably some of you in this room and on the podcast around the effectiveness of the program and what it should look like going forward. So what will generate innovation investment in Australia? So coming out of those reviews was this concept around intensity. So in the budget in May of this year, the government announced some changes to the program. They were tiered to below 20 million turnover companies and above 20 million to mirror the tiering of the program. And I'm going to focus today just on those to give you a high-level summary of the changes that impact the above 20 million turnover. So, and I wouldn't call those big companies. So I would say to you that that tier has been in place around the refundability, affordability. So refundability for me is at below 20 million and above. Non-refundable is the above 20 million turnover. There were three major changes that the government announced that they plan to implement from 1 July 2018, so for years commencing for that, for those companies with a turnover of over 20 million. Essentially, they've linked those companies, their rate, to an intensity test or an intensity measure. And that intensity measure is really R&D expenditure versus your total annual expenditure. We don't know what that annual expenditure definition is yet. It wasn't provided on the night. And there is all sorts of discussion around what should be included. And we look forward to the consultation around what will be included in that definition. So essentially, we've gone from having one rate of 8.5 cents, non-refundable at that level, before 1 July 2018, to potentially 4 levels. So we're going to see a level at 4% intensity for R&D expenditure. 4% of R&D expenditure would be supported for those entities that have a intensity test of meet the intensity threshold, between 0 and 2%. So that's pretty high, and that will capture, we think, a lot of companies. And then you then progress to 6.5 percentage points for R&D expenditure above 2% to 5% intensity. So that doesn't include, though, you'll only get that for that intensity that goes above the 2%. So it's a staggered program. So you don't get all in at one level. It will be staggered and calculated across the 4 rates. On the next slide, the third category is 9 percentage points. So that really is very close to the current rate. For those companies that will have an intensity of between 5 and 10%. And then beyond that, for companies, will access 12.5 percentage points for their R&D expenditure, which is above that 10% intensity threshold. So there's those 4 complex. It's complex. It's tiered, so you go through the various stages based on where your expenditure will sit. We've calculated in order to get the same level of support that you currently get at 8.5 cents, you've got to have an intensity of around 13%. So to get the same access. So you can see that that's quite high. The second major change is in order to reflect that there will be some companies that will get that very high intensity, and to reward that, they've increased that annual spend cap from 100 million to 150 million. So that's a good outcome for those companies that are high R&D intensity and doing R&D here in Australia. And the third major change for entities above 20 million, which I know is going to be covered further on in the session today, is really around further guidance, around the administration of the program, and some technical amendments that have been flagged that they are seeking to achieve. As I mentioned, everything's applicable from 1 July 18, but we haven't seen the law yet, so we're still waiting on the law. So at this stage, we've only got these announcements and the summary papers that are available. So why have they done this? And in essence, you know, what's the aim? So there is an aim in the program around supporting additional R&D, and there is a belief that an intensity measure will achieve that additionality concept. There is no other regime around the world that has an intensity measure, so this is unique to us. There's a couple around additionality of getting an increase, but nothing like this. So from that perspective, it's, you know, something that's unique to our regime if, when it's implemented. And I suppose, and lastly, my last comment will be is that we think that a lot of claimants will be in that 0 to 2% intensity, because people aren't making major or tracking their R&D expenditure. We believe that will get over the 2% intensity threshold. So most will have their benefit more than halved. So from going from 8.5 cents to 4 cents in the dollar. So that's not a great outcome for those companies undertaking R&D here in Australia.
Sandy, perhaps just to try to put that in context, obviously there's a large number of companies at the lower ends of those thresholds and a small number at the top end. I can only think of a couple at the top end. I guess there's a question there. Is this actually redirecting, I guess, the support for R&D towards those small number of top-end organisations? Is that do you think that's either an objective or a fair observation to be made?
It's possibly a fair observation around the government's intent, and there is a real passion for supporting that additionality within the Australian economy. So the concept, and you may have seen this if you've had, if you've seen the taxpayer alerts that were produced about 18 months ago, this concept of business as usual, so moving away from supporting business as usual to additional R&D. So yes, I do think that there is an intent to support that intensity piece, but it doesn't mean that those companies that are in that band of 0 to 2% intensity are not doing genuine R&D, and that's the challenge that we face.
Yeah, if I may add, and I completely agree with Sandy that, you know, I think we can come to the business as usual argument a little bit later, and which is a good one. But I think what we've seen also is the modelling that we've done shows that it really is a savings measure. You know, it's not like what we've got has been actually redirected, because those few that you're mentioning, most of them will be just back to square one. You know, they'll just be in a same position as they are now. And it's really a combination of that blended rate that Sandy explained we will have, and the cap. Because if you could then access it indefinitely for your high intensity expenditure, you know, then they would benefit more, but the cap still kicks in. So you might actually not be able to take advantage of that highest rate for much of your expenditure, if you know what I mean. So I think it is actually, as we're seeing it right now, a savings measure, and hopefully we'll see maybe support for more direct funding.
And I mean, I think you go back to that point of you need to spend, you've got to have, you know, you've got to have a very high intensity of 13% to get access, to get the same level of support that you're getting today. So yes, you would think that that's a savings measure.
Okay, questions from the floor here? Any questions? Question over here?
What do the budget papers say about that savings measure?
Sorry, you've got a mic there. We might just use that if you don't mind.
You sort of said that assuming 13% total expenditure, what do the budget papers say from a revenue point of view as to...
What's the savings?
Yeah.
So the savings are have been modelled out to be $2.4 billion over forward estimates. So
what is the general feeling out there? Is the government open to consultation on this? Have they invited any consultation on these measures that are supposed to come in for next year? Or
Government consultation. Government consultation
So there has been government consultation as part of the 2016 review of the R&D tax incentive, and again as part of the ISA report that came out earlier this year. In terms of the actual draft legislation, like Kristina and Sandy alluded to, we haven't actually seen any draft law to provide commentary on. We were expecting to see that in June this year. Obviously there's been some delays to that, but when that draft law does come out, I suspect we'll have a window of about 3 to 4 weeks for consultation.
Other questions from the floor here? I just repeat for those on the webcast, if you do have questions as we're going through, please click on the bottom right-hand corner and ask them as we go. I've got an iPad here, so very happy to take questions from any of those 280 odd folk listening in as well. Any other questions before we move on? No? Okay. All right. Look, we'll move on to Laurence. Laurence is from EY. Laurence is going to talk a little bit about the proposed R&D changes for the, if you like, the smaller companies, the smaller end of the spectrum. So I'll hand over to Laurence.
Yeah, thanks, Mark. Obviously going to be just talking about the changes as they're relevant to the smaller companies. And I think the first thing to note there is that the definition of a small company hasn't changed as part of these proposed R&D kind of budget changes. The definition is going to remain as aggregated turnover of less than $20 million, and that includes connected and affiliated entities. And it always begs the question as to whether at this day and age that's still the right level to classify a small company versus potentially one of the larger ones. If you look back at the most recent Aussie industry statistics, and this just gives some context, for the 2016-17 year, I think there was about 83% of all claimants of the 15,000 claimants under the program. 83% of them were classified as small companies. So just give some context around how that split's made. Kristina talked about the refundable element that came in. Pleasingly, there's no change suggested. There's going to be a refundable element that continues on. However, there is an introduction of an annual cap of $4 million as part of these changes. And anything above and beyond that is going to be passed on back to companies as a non-refundable tax credit, which is obviously just going to add to the pool of carry-forward losses that a company can access at some point in the future when they become tax profitable. In 2016, when the FFF report came out, that report was I suppose the first recent reintroduction of a cap on the refundable element. At that point, the level was suggested to be $2 million as opposed to the $4 million that it is now, and there was a lot of feedback from industry, from business, that level was too low, and pleasingly, I think that message has been heard, and a more generous amount of $4 million has been applied in this case as part of the proposed changes. I think, from my own personal perspective, I think $4 million is a generous level. And it in some ways it gives a bit of responsibility back to those companies that are claiming significant refunds to actually start commercialising the output of their R&D programs. So I can see the benefit of having a cap of that level in place. Interestingly, there was the introduction of an exclusion to this particular annual cap, and that is around clinical trials. And so I know the Australian life sciences industry, Oz Biotech and others have been campaigning pretty hard over the last couple of years since it was first introduced back in 2016 to oppose that particular change. They've obviously had some success there, and speaking to a couple of companies in that space where it's relevant, a couple of questions have kind of been raised, and one is a definitional one. There's a few different definitions of what constitutes a clinical trial, whether you look at the World Health Organization, OECD, there's TGA, FDA, all have slight different variations. And I think when you're looking at clinical trials in the context of things like vaccines, surgical instruments, intervention, and diagnostic tools, there's some uncertainty around whether that would be classified in a clinical setting to be clinical trials or not. The other question that's come up around this particular item is whether those companies that are doing overseas clinical trials under the Overseas Advanced Finding process, whether the overseas component will be exempt from this annual cap as well. And then just lastly, the point I just want to leave on here is that there's obviously that relinking of the R&D tax rate back to the claimant's corporate tax rate. So instead of having a fixed 43.5% not a refundable tax credit or tax offset, it's now calculated as the claimant's corporate tax rate plus the 13.5%, and that I think is particularly relevant in the context of a reducing corporate tax rate in Australia. And certainly there are some companies already, particularly those that are that have a turnover of less than $10 million, already have a reduced corporate tax rate, and the benefit that they're accessing at the moment is in the order of 16%, which is above, I think, the policy intent of that 13.5%. So I think that measure just realigns to what was initially planned.
Thanks, Todd. Just a couple of questions that have come through online from folk watching on webcast. Question here: does the panel have any insight into how the annual expenditure might be defined for the purpose of intensity trigger, or how do you expect it to be defined?
Yeah, look, I'll jump in first. Good question. I think the answer is, look, it's yet to be determined. You know, there's people that think it's going to be deductible expenditure, deductible operating expenditure. There's people that are saying it's going to include deductible and non-deductible. You know, the answer is unclear, I think, until we see the draft bill as to how that plays out. I don't
And
know
the
whether
other,
Helen
no,
has any
it's
insights.
totally agree, Laurence. And the other question that's come up is, will it be just Australian group, or is it, you know, global group expenditure? Which, you know, it's likely to be Australian, but, you know, we don't have any certainty around that. And of course, the other thing that's going to make it harder for companies is they actually need to determine their R&D expenditure before they can decide how the new rates apply and to what extent. So it's actually, I think the compliance burden will increase as well. And we expect that the R&D expenditure will actually be qualifying R&D expenditure.
Yes.
You know, so under the incentive, because there's an argument to say, well, it's just what you would otherwise classify as R&D expenditure and disclose in your accounts. You know,
Questions from the floor? Questions? Can't see around the lectern. No other questions on small companies? No? Okay. We might move on then. I'd like to next introduce Todd. Todd's from Deloitte. I guess I'd just to position this one, Todd, ask, as well as obviously legislative changes, there's been a significant increase in regulatory activity with integrity measures being introduced last year. Can you give us I guess your perspective on that?
Yep, not a problem. Yeah, look, the R&D world has been a very difficult place to be in probably the last 2 or 3 years. Oz Industry and the ATO have really ramped up their compliance activities in terms of reviewing and auditing R&D claims, and that's from the small end of town all the way up to the large end of town. I think the battle that we face with the regulators is, personally, I haven't had many issues with the ATO. It's mainly been with Oz Industry and dealing with Oz Industry assessors who seem to have a very negative attitude towards what R&D is in Australia, where they're doing everything they can to basically destroy it and getting our companies to move their R&D offshore. It's very disappointing. Dealing with Oz Industry can be very, very difficult in terms of the time frames that they take to turn around advanced findings, overseas findings, and just the way that they present and handle their reviews on any R&D claims. So I'm not sure where or why they are being particularly difficult, and it's right across the board. As I said, it's small companies all the way through to large companies in every different industry you could possibly imagine. Some of the projects that have been considered ineligible that I've seen are just staggering. The companies involved in stem cell research, the biotech companies and Oz Industry have come back and said, no, this is not R&D. In their reports, what they give you is not a reason why it's not R&D. It will just say it's not experimental. That's it. Not another word. They won't meet with companies to describe and discuss projects. They go away for 6 to 8 months and then come back with a negative report. And as I said, this is right across the board. So it's something that we need to really stand up to Oz Industry and start to fight them. Because it's just unfortunate for some companies. Some companies are being forced into administration because they've been forced to pay back their R&D incentives, and it's happening more and more. And it's just very disappointing for the Australian economy, seeing that we want to be, the government's saying that we want to be an innovation economy, but we've got a department that's doing everything they can to stifle that. So look, that's my view on what. And as I should say, is with the new incentive when it came in 2012. And all of us were all down in Canberra talking to Oz Industry about what they want to see as R&D, what documentation they want to see, and then probably about 3 years ago, I think things changed. They changed their mind on what they wanted to see to support claims. There's a very big disconnect between the documentation that Oz Industry want to have or want you to have compared to what scientists and engineers and companies think they need to show to prove that they're doing R&D. They're two different things, and we need to get together and sort it out because we're just going downhill pretty fast. So look, that's my view on the changes in the regulatory environment at the moment. But with the integrity measures that are coming through, and that's on my slide, there's 4 main points that were raised in the budget. The first one is that compliance and improve the administration of the incentive. Now, that could be a good thing and a bad thing. I'm hoping that some of the funding is actually going to be for Oz Industry assessors to be probably briefed a bit more on what is R&D in Australia. That might help a long way. But also, I think, I know that Oz Industry and the ATO are planning to release more guidance material on what documentation should be kept and just more guidance on what they want to see. But having said that, Oz Industry have got a view on what R&D is, and most companies that are doing R&D have their view, and they don't match at the moment in a lot of circumstances. We need to get together and sort it out because it's just not a healthy situation that we have. Other integrity measures that will be rolled out is they're going to increase the transparency of R&D claims, and what that basically means is I think the ATO are going to produce lists of who the top 100 R&D claimants are and what their expenditure is. It's in line with all the other tax transparency initiatives that the ATO has at the moment, so I can't imagine there being too many problems with that. I don't think the ATO will want to go in and publish what R&D each individual company is actually doing. It's just purely a numbers game. The third point on my slide is limits to the time extensions to complete R&D registrations. Now, I wasn't sure exactly what they were referring to there because normally you've got to lodge your R&D claim by a set date, but there is a mechanism there if you have exceptional circumstances that you can potentially put in an R&D claim after the time, the statutory deadline. Now, what I've seen in the marketplace is there has been some consultants making I wouldn't say abusing it, but stretching it a little bit in terms of finding a company that hasn't claimed R&D and then getting them to come up with reasons why they haven't put an R&D claim within the deadline. And the different reasons could be that there was a change of management, there was a major disaster in the company, your accountants advised you that you couldn't claim R&D. Things like that. They were sort of the reasons that you could give Oz Industry, and then they were pretty much allowing some companies to put in claims. Now, what I think with the limits to the time extensions is probably they're not going to allow you to go back 3 years or 2 years or maybe just 1 year, or if you miss the deadline, they might give you an extra 3 months maybe to put your claim in if you've missed the deadline. I think that's what it is. As I said, there's no law yet, there's no legislation, so we're not sure exactly what they're referring to. And the other last point is there's going to be obviously various amendments to the technical provisions, probably in line with what grant clawback, feedstock and any anti-avoidance rules. And that'll probably be linked, I should imagine, to the R&D intensity and whatever R&D premium that you're on. So they're the integrity measures. And probably in a summary, I think the first point's the important one, is how Oz Industry is going to administer the R&D incentive, and is it going to be fair for everyone, or is it going to be to the detriment of the Australian economy? Thank you.
Thanks, Todd. Questions from the floor of Todd? We have a question over here. We'll just get the mic.
If you get an adverse finding from Oz Industry, is there an appeal process?
Yeah, at the moment, if you get a negative 27F finding, you apply for what's called like a reconsideration under Division 5. So you can get a review of the original finding. If that review is still negative, then you're off to the AAT. And I think one thing that's sad at the moment is that a lot of small companies are copying it from Oz Industry, and they're being forced all the way to the AAT. Now, when you go to the AAT, it costs a lot of money. And some companies are small, they're only getting refunds of $200,000, $300,000 per year. Go to the AAT, that's going to eat all your benefits, so you're going to have a negative net gain. So there's mechanisms to do it, but it costs you a little bit of money if you go all the way to the AAT.
What we've also seen just recently, I don't know whether you've seen that, Todd, but is the ATO is actually starting to levy penalties, which is, which really was unheard of in the past, so, and, taxpayers are really trying to protest that, because it is kind of with a retrospective view of what Oz Industry and the ATO want to see now, and so that's an interesting kind of observation and development as well, in my view.
What irks me a little bit with Oz Industry is that they come out and say that they've never changed their view from when the day one when the incentive first came in, which is, it's just, look, in my opinion, it's just not true. I think it might be a change of the guard with various officers and managers at Oz Industry who have now a different opinion, but also I feel that Oz Industry have this negative opinion on all R&D claimants, that it's some sort of fraud or some sort of rort, which is not. Now, I think there's probably been about 10 companies that might have done the wrong thing, and there's about 13,000 claimants, so it's very, very small. Most companies that I know of don't want to play around with their R&D claims. They're doing legitimate projects, and they want to actually do it in Australia instead of doing it overseas. So it just frustrates me.
Yeah, and I think what we're specifically seeing is the mindset towards software development. That is a big concern. It's a concern to me, because our economy is shifting from one of sort of being based on primary production and resources towards more services industry, and really digitization is across all industries. So I see that in advanced manufacturing, smart cities, autonomous vehicles, you name it, everything will be digitized. So every R&D project will have an element of software development. And to say that that isn't R&D, I really feel very strongly about that we need to find a way forward with that, because that would really mean that we're missing our opportunity as part of the fourth industrial revolution. I really do.
And if it is determined that it is eligible R&D, it'll only be majority of manufacturing, for example, will fall within the 0 to 2% of R&D intensity, and therefore the benefit of doing R&D here in Australia will significantly drop. So you're currently getting 8.5% support, and you'll go to 4%. And you might have a big manufacturing facility here, you might be set up in the region, so it's sort of detrimental to supporting that investment here in Australia.
So Sandy, I guess there's a broader fundamental question there. Where, in your view, does it leave Australia, and do you see multinationals potentially simply relocating their R&D facilities in the medium term?
Yeah, so to Kristina's point, I mean, the R&D dollar is very fluid. these regimes now exist everywhere around the world. And I think some of the other countries have got it right. You know, they're saying they're open for business, they're there, we're not going to touch our programs for 5 years, so the French have said that. The UK is saying we're open for business. Now, they've all got their political reasons as to why they're making those statements, but essentially the R&D regimes are used to incentivise companies to park their R&D projects in those jurisdictions, and they're all very competitive. Hong Kong recently announced that they are introducing or have introduced an R&D regime. New Zealand has as well. So I think we'll see projects move offshore and not come back, and that will be a shame for Australia. So we'll see this ability for particularly larger entities to go, look, actually I'm not going to, I can get better support to do this elsewhere, so I'll put my developers in another jurisdiction that has a better program or a better rate of support. And actually I'm even hearing that from smaller companies where there's not this combative environment around eligibility.
Yeah, and I'd agree to that. Particularly, look, I don't think we're going to see any companies that are immediately going to shift their R&D infrastructure and capabilities offshore on day dot. But certainly where there's a multinational that has some global R&D planning function, you know, be it manufacturing or clinical trials, pharmaceuticals, whatever it might be, I think we'll certainly, over a period of time in the medium, particularly in the long term, that this change will feed into the decision-making process as to how they, from a global perspective, kind of locate their R&D and their R&D facilities. And I think, you know, over time, there's going to be a move to the more favourable jurisdictions when it comes to R&D.
Look, I must admit that I'm aware of 2 major multinational companies that are going to be moving their technology arms to Canada. There's one that's going already, and the other company is an oil and gas company in Perth who are going to shut up shop and move back to Houston. So they're just 2 examples that are coming through now, and then that's probably even before these changes. The ball was in motion. So we really need to have a hard look at ourselves. Are we serious about innovation? Are we serious about R&D in Australia? And then address it.
Yeah, absolutely. And I think, you know, it's not just the reduction in the rate, but it is, Todd, to what you explained, also the pressure from the regulator. It's not so much pressure, but it's really that uncertainty, you know, that you just don't know, is it going to hold up? How much scrutiny will you have to go? It does take the resources from actually doing more R&D to going back and trying to justify, you know, why the previously claimed R&D. So I think more balance is really important going forward.
That's right. I think, look, to be fair to Oz Industry, I know I might have given them a bit of a stick today, but when you're looking at IT projects, they're very difficult to understand as well. So I think Oz Industry needs some more training on how to identify, you know, anything to do with IT, computer science, that type of, just to get their heads around it, because it is difficult. It's not an easy thing to do. It's not like you're in a lab with a Bunsen burner and your tripod and your beaker and you're heating up a chemical. It's a different sort of R&D. And I think they need more help in terms of how they analyse those projects and how they actually work out what's a core and supporting activity. So hopefully with the integrity measures coming through and there's more money for compliance, that some of it's in training, just to help them out, because I know it is difficult for them to get their heads around those sorts of projects.
Questions from the floor? There's a couple of questions over here, if we can get the mic over there.
Yeah, I think you might have just answered some of my question. Obviously the discussion there's fairly negative in terms of R&D in Australia, and I think it does, a lot of companies, like my company for example, will look at the 4% and look at the 12.5 coming in New Zealand, and maybe we won't do a claim here, but we'll do one over there, and start shifting like you were talking. So I'm just wondering, is it really getting to the stage where it's almost, you know, if they're going to regulate it like they're regulating it and reducing it to the extent they're reducing it, where most companies are going to have this really small amount, that the numbers really stack up, you know, in even having does it fundamentally bring into question the R&D regime, tax concession, if it's getting to that point?
Look, I think that's an excellent question. because there was word before the federal budget that, and that was actually the recommendation, the 3F report, that below the intensity threshold, there would be no access to the R&D tax incentive, you know. So it looks as though, oh, it's not so bad, you know, still at 4%. And yes, I think, you know, the message can be from government, we're still supporting large businesses as well, just not as much because they don't need it as much, you know. But you're right, you know, it's a lot of effort that needs to go into it in terms of the compliance. And will there be some taxpayers who will say, well, actually, just too hard, you know? But don't know. We're yet to see this, you know. But it is possible, so yeah, very.
I think to your point of the cost of compliance is going to definitely increase. You've got a lower rate of support and a higher cost to actually undertake and complete a claim. As Kristina pointed out earlier, you'll have to understand what your R&D expenditure is before, and your and your total expenditure before you can make a claim and understand what level do you sit within. So you're going to have to incur these costs prior to understanding the level of support that you'll actually be able to access. Yeah. And if you've had an event during the year where you may have spent some money, you may have established, you may have spent some money on a new acquisition, or will that put you out for that year? I mean, it's very difficult to know throughout the course of the year whether you'll be able to access the program as it reads today. I mean, hopefully those things will be ironed out throughout the consultation process.
Totally, but the key for those who do continue to claim and to, help a little bit with the compliance cost is absolutely in a forward-looking approach, to actually make sure that your documentation is right and that you actually can substantiate it in the way that we think, will be accepted by Oz industry. We haven't got full clarity on that yet, but, hopefully we'll get to that point. So it's really critical to have the right documents substantiated and have that in place as you undertake the R&D.
I think there was another question over the side here.
I just had a question just generally, but also directed to a gentleman from Deloitte. Just compliance activities, the ATO report objections that are lodged each year, it's a reasonably constant figure. Does Oz Industry report Section 27H adverse finding investigations and the ones which are adverse? Yeah. Is there any sort of publicly available data on that? For example, is it 1% of claimants?
I don't think they list them publicly, but we do hear some of the data. We had SRG, which is a reference group meetings.
Yeah. 1% was.
Yeah, I guess. I think there's probably more than 1% at the moment that'll be adverse findings. I'm not sure what the number would be, but I think if you're getting a review in, say, building and construction, IT, even some agriculture type stuff, and probably some of the smaller miners, I reckon probably all your findings would be pretty much negative or a large percentage. I'm talking over 50% at the first stage. That's at the 27F first stage review order. That's what it would be. And then depending on how much you want to fight, if you want to go all the way to the AAT, you might have a bit better luck, or you start negotiating on what's in and what's out.
Other questions from the floor? A question over here.
Having gone through an Oz industry audit not too long ago, and having it disallowed, our company has decided to abandon R&D totally, which is probably what a lot of companies would do as the incentive is lower as well. But is this a role that perhaps Board of Taxation could get involved in trying to, get Oz industry to understand the roles that we've gone through in these reviews? I know in our case we had a case officer who had no science background, so it was very difficult in a highly engineering world that we came from to get her to understand the R&D that was being undertaken. And that was just a list of litany that we had. But I think perhaps there is a role for the Board of Taxation to be our voice.
Yeah, definitely. I think it's got to be a joint effort. It's across every industry. We've got to all go together, and I'm talking about the Minerals Council of Australia, Oz Biotech, whoever else there is. That's one of the professional bodies. It's us, the consultants, and the companies themselves. I know of 4 companies that have gone directly to the Minister to express their concerns with the R&D claim process and what has happened with their reviews and audits. Speaking to the Minister's advisors, they are very keen to hear directly from companies and claimants. They don't necessarily want to hear from us, and they may not want to hear from the industry bodies as well. But if you're a company and you've been given a hard time by through your R&D claim audit, go directly to the Minister. They're willing to listen to what's been happening. So look, as I said, as you in the unfortunate circumstances for your company, but it's happening across the board as I said, a number of different industries, different companies, and anything you can do to actually bring this to the table and get it out into the broader community on what's actually happening to our economy, it will be helpful.
I'd certainly say from a G100 perspective, our members, I mean, we are taking individual issues to ministerial level reasonably frequently at the moment. And I've got to say that it's a pretty open door. That is the experience. So you think they are all looking and facing out like a collective, but I'm not sure that that's correct. And we're particularly just in the next couple of weeks having some discussions with the health portfolio around therapeutic goods approval processes, and a few of the sort of almost crosses over R&D. A few of our members are getting, I guess, facing up with significant bureaucracy in that space relative to other jurisdictions in other in other countries. So I'd second that comment certainly. Any other questions from the floor?
Just another comment. The ABC Four Corners report on the R&D. That was very interesting. I watched that. I got a bit annoyed because I felt that the reporting was focusing more on the ATO, whereas really the issue was with Oz industry. And so it was an opportunity to bring something to the table, a broader audience, and it was reported slightly incorrectly and laying the blame at the ATO, where we know that all these audit reviews are initiated and concluded by Oz industry. The ATO just follow through with the assessments that Oz industry make. And it's unfortunate that it wasn't corrected, or they didn't speak to one of our panellists to get that correct.
Well, look, that's right. I watched that Four Corners episode, and there were at least 2 R&D matters mentioned there, and the ATO copped it, where R&D matters always start with Oz industry. It's very rarely does the ATO instigate an R&D audit. They do happen, but it's very rarely. Oz industry will start the ball rolling, and then that's when the fun and games begins.
Or if they do instigate it, it usually is the Oz industry decision that actually makes it fall over. I think that's probably also fair. So sometimes the ATO does instigate it, but they obviously defer to Oz industry. It actually usually falls with the activities. That's where the biggest controversy is, and that is Oz industry's jurisdiction. So. And that's what we say to most people. It's not so much the expenditure, it is actually, if there's no R&D, then, we don't really have to go. The ATO has nothing more to do.
Guys, maybe Todd or Laurence, can I just ask a question probably that's specifically in the area in my day job? The 3F report that you referred to before, it did make mention around premium rates potentially for industry-university collaboration, yet it didn't really feature, to my knowledge, in the budget, the last federal budget. Have you guys got any insights or comments about the likelihood of something happening in that space?
You can go. You do it.
Look, I think it's disappointing not to see the collaborative premium introduced as part of these budget changes. It was first recommended in the 2016 FFF report, and then again I think it was confirmed as a recommendation as part of the ISA report earlier this year as well. And I think in an environment where Australia doesn't do particularly well in business engagement with the publicly funded research sector, this would have been a nice addition to really incentivise companies and the universities, for that matter, to work collaboratively to build innovation, to build R&D programs that generate real life and commercialisable results. And so I know that the premium amount was thrown around at 20%. For engagement by businesses to universities, CSIRO, but also interestingly for the employment of STEM-based PhD graduates into businesses to actually work on these business R&D programs as well. So from my perspective, I think it's disappointing. I really hope that we see the introduction of this mechanism either as part of the draft bill that's going to come out or subsequently.
I agree, Laurence. And what's interesting is that actually in the government funding framework for the universities, they already have that requirement now to collaborate with business, with industry. But now I think what we're missing is the other piece, is that actually to incentivise the businesses more to do it. Obviously they are, in the sense that it's a great resource to have someone from the university, but yeah, we really need to get that incentive.
There needs to be more. I think there's always a sticking point around ownership of IP, roles and responsibilities when companies are dealing with these research organisations that are publicly funded. And I think, obviously that needs to be addressed, but then to have some other incentivisation there to make sure that engagement happens, I think is important.
Yeah. Look, it's been. I do know a few pretty senior execs in Canada, and as I understand it, not as they described it to me, in that area, it's almost as simple as if industry is prepared to put up X amount of money into a university environment, that the Commonwealth or the government will fund the other 50%. There is no application. It's simply, is there money being put in? Yes. If so, we'll match it. And there is no compliance. There's no regulation. It's simply reliant on, well, if industry thinks it's a good thing and they're putting their money behind it, then we'll put our money behind it. So it almost seems too simple to me, but that's how I understand things have worked there for a period of time. And maybe that's something to do with some of the comments that were made earlier about some R&D moving.
I think so. Look, by May next year, there's going to be another election as well, and we need to factor that in. And I know Kim Carr, who's the opposition leader for industry, I know he's very keen on this collaboration, premium rate, incentive, whatever you want to call it, if companies and universities work together. He's been peddling that for probably the last decade. So if there's a change of government and the Labor government comes in, I would expect a collaboration premium incentive will come in the next, or their first budget. And that's what I expect. I'm not sure if it'll come out in the legislation that'll come out now, but if there's a change of government, I think it'll come in.
So does that almost go to there's been some talk about direct government grants. That's really, I reckon that's really getting closer to that.
That's right. With the $2 billion or the $2.4 billion that has been taken out of the R&D tax incentive, we're expecting some of that money to be pumped into direct R&D grants, and it just basically it's disappeared into the coffers. I'm not sure if that's going to change. I doubt it this year. But it's something that we should look at. I know there's innovation grants that Oz Industry promote, but they're only very small. They're only like 50 grand, and some companies can't get out of bed for that amount of money, and it's not really going to help a major R&D project.
Guys, just two quick questions that have come in from the webcast participants. Shelley asks, for early balancing company, do we need to apply the intensity test from the 1st of January 2018?
No, well, it's not clear again because it's not in the law yet, but I presume it'll be from 1 January 19.
Yep. Right.
Yep.
It'll be so for income years starting on or after 1 July 2018. So, yeah.
Okay. And another question from Josh Leach. Are any of your client base thinking of not claiming at all on the basis of benefit may not justify the cost of compliance?
Yes. Yep, for sure.
Yes.
I think we're probably all looking at the same thing, is probably trying to, as I said before, with R&D claims, it's the documentation that you have to produce to support your claim. So if we can work, the documentation has to be lodged with your R&D application with what your engineers, scientists, project managers are doing, and basically make it a seamless, will hopefully keep the cost of compliance down a little bit, so we're not doubling up on paperwork and documents like that. I think that's probably one way to do it. Other than that, honestly, in some cases, it's going to get very marginal. It's going to be very difficult.
I think the other thing to think about is the in-year, like identifying your R&D as you're doing it,
Yep.
versus waiting until year end and then trying to do that process of look back. It's never as seamless, it's clunkier, it takes more time and more cost, it takes time out of your business, so you're better off to track your R&D on a real-time basis, and that I think will reduce and make the whole process more efficient.
And incorporate the narrative within the business from the outset.
Yeah.
In the documents, business cases, board papers, all of that.
Other questions from the floor? Question over here.
Michael Croker, Chartered Accountants Australia, New Zealand. So, agree with all the comments, but one of the things we're hearing is that there's a need for a better model around some of the aspects of R&D. Todd's raised a very interesting question about how we actually get some sort of independent review of adverse R&D decisions from Oz industry, which is a discussion we typically have with the about the ATO's decision-making process. But I think it's just as opposite in the Oz industry context. But the thing that we have been faced with is the suggestion that there are advisors who are not doing the right thing by the community in the sense of gaming the system with some R&D claims, which if they're successful, the advisor gets a clip of a ticket and makes their money that way. Is there a better model that you can see? And we've been toying around with accreditation, for example. I mean, I don't think the people in this panel will have any trouble with that, but this idea that there are some advisors out there who really don't know their way around the regime and what constitutes innovation and R&D. I know you've made comments about Oz industry officials, but we're hearing that some similar accusations can be levelled against the professional community.
That's a fair call. I think at the last state reference group meeting I went to, it was probably about a year ago, I think Oz industry came out with figures that in Sydney, I think there is probably 150 different R&D tax advisors or firms that are doing R&D. When I started doing R&D 20 years ago, there's probably about 10. So there's been this massive proliferation of advisors. And I think, speaking for the big four firms, we're under pretty strict rules on what we can and can't do due to audit relationships and any other regulatory things that we have on top of us. But some small R&D advisors who are just operating from home may not have that same level of scrutiny and on what claims that they put in, I suppose. So accreditation, it's something that's been talked about for a long time in the R&D world. It's the same as like your export market development grant type things as well. Whether that works, I don't know. I'm not sure. But you have to be a tax agent pretty much now. So hopefully that controls some of the advisors and what they do and what they don't do.
I gather there could be an R&D promoter penalty action underway as well. So that could flush out a few people who should be advising.
Yeah, and I think it's a spectrum of, at the very severe end, there is some fraudulent activity going on, and we've seen it again in the press. People have been actually prosecuted. And at the other end of the spectrum, there are people who just don't know enough, maybe, and aren't as versed in the rules. And I think, to give you a really simple example, I always feel when it comes to the refundable offset, how many of the small advisors really probe into the turnover test, that it's actually an aggregated turnover test and what you need to take into account. It's just an example, because it's not because of wanting to do the wrong thing, but I think, sometimes that's probably an area where things probably slipped through, to be honest. Like,
I think, Michael, we like the idea of an accreditation program. I do think it would bring the rigour to the framework and ensure that people were doing regular training and being kept abreast of changes, etc., that the regulator would like to see. I mean, that would make sense. So I think it should be an extension really of the tax agent regime. And yes, most are tax agents, but I'm not sure all are. So I think it's a great idea. I think we'd welcome that.
Other questions from the floor? No? Oh, sorry, one question over here. If we can get the mic over.
Sorry, last question for me, a bit indulgent. Just going to reform, just very briefly, advantages and disadvantages of a proposed UK-style patent box system. What does the panel generally think of a UK patent box type system in Australia? I think it has been ignored. My last looking at it about 2 years ago.
I think we all looked at it 2 years ago. I don't think we've really been discussing the patent box process or the way to do it in Australia. I don't really have any comments at all.
No, I think our focus is really on getting this program right and understanding and allowing companies ease of access to the R&D tax incentive would be paramount. Again, similar to Todd, no real comments on it as to whether it was being floated a few years ago, but hasn't been raised again, I think.
Yeah. It's been pared back also, even in the UK. So it was much more generous previously, and so I think that the question is how viable it really is, and what sort of hurdles are put into the system to make it a long-term viable proposition.
Yeah, I think just more broadly, the discussion's been around. Obviously, there's $2.4 billion worth of savings over 4 years from these proposed changes. The question is how best can they be redirected to support innovation in this country? And there's been recommendations that the Export Market Development Grant get an additional boost of some funds, some more directed grants looking at translational type or commercialisation type activities for the commercialisation of R&D programs. So more like competitive grants where your patent box hasn't really come into the discussion this time round.
Other questions from the floor? No? I guess, guys, just trying to sort of bring this to a conclusion, a summary. This question to you, Sandy, in your view, directionally, are the announced measures going to impact our ability to step up innovation overall? It's been spoken about at least for the last 3 or 4 years in a lot of detail. It's a big word that's been out there for a long time, and I guess everything I'm hearing today is it's not probably, it's almost misaligned with that.
Well, I think you're right. I think we do need to see and support innovation in Australia. I'm really passionate about it. I think if we want to do that next generation of development and become, keep up with the pace of change in the global economy, we must innovate here. And companies want to do it here, and it's all about the cost of doing it here. So we need programs like this to be sustainable and effective. To support that parking of R&D here, to stop the leakage overseas. I think there's a recent study that was done that for every R&D job, there's 5 direct and indirect jobs created. So it creates jobs. It serves us so well for the future, so it's so critical. And I think we need to focus on these sort of programs as a critical lever to bring that R&D here, keep it here, and also for smaller entities as well to have that ability to innovate here in Australia, but also companies of all shapes and sizes. That's the beauty of a program where it allows innovation to find its own place in the economy and the next stage of where that next groundbreaking development will be. That's why it's so good. It's not directed It's not someone picking a winner. It allows R&D to find its own place and innovation to be undertaken organically and where it should be, in my view. So this change and a reduction for a lot of claimants is going to impact that if when it's implemented.
Okay. Any final questions from the floor? No? Look, guys, I might wrap up now then. That's good timing. We're sort of 10 or 15 minutes early, which is great. Just a final couple of thank yous, particularly to the expert panel members here. On my left, Kristina Kipper from KPMG, Sandra Boswell from PwC, Laurence Osen from EY, and Todd Fielding from Deloitte. Guys, thank you very much for your time and for your expert input to today. To Walters Kluwer and Heather, thank you very much for your coordination of today's event. To CPA Australia, thank you very much for making their Sydney office available for this. And finally, to all of the attendees, both here present in this room, as well as the 280 odd people dialed into the webcast. Thank you very much. Hope you've found something interesting and informative from today. Thank you very much.